Hello and welcome back to the Simulated Trader. All right, so this video is putting it all together. If you had been with us from the beginning, you've understood how we are talking about the four levels of understanding, if you will, four levels of context. And first we started with level one, which is the ecosystem where it's not just one market. As you can see this chart here that I'm looking at, this is level two as far as an environment. And I specifically talk about looking at these four macro assets within the ecosystem. So it's not the bond market, it's not the gold market or metals, it's not currencies or forex, it's not that market, and it's not oil. It's not; these aren't separate markets. They're asset classes inside one ecosystem. Okay, so just because you don't trade forex doesn't mean you shouldn't be paying attention to it. And that's the whole point of the environment. If you understand what's going on in the environment, then you're going to understand how it's going to affect the next level down, which is going to be climate. So level one is ecosystem. Everything's contained within the one system. Level two is the environment, and we're going to get into greater detail today about this. Level three is the climate, and level four is the weather. So everything compounds down to the point of actually trading the asset within the asset class that you are particular about. Now, the last four videos, we went into depth about the various four oceans, and those being bonds, which is the cost of money or the benchmark; gold, which is the fear barometer, trust in the system; the Euro USD pair, which is confidence in the currencies, the two major currencies on global economy; and finally, oil, which is the economic growth indicator. So what I'd like to get into, and this is why I have these charts. I'm gonna pull up a different chart here in a minute, and we're gonna really get into each one of these on the daily basis. And what I want you to take away from this and consider is I want you to compare and contrast the asset that you actually trade. Whether it's Apple, any of the Magnificent Seven, whether it's indexes, I don't care, whatever it is, right? Because it's all within the same ecosystem. Remember, it's all one thing. And each of these particular four macro assets are going to have ripple effects against the entire system, whether you trade it or not, specifically, but indirectly it's going to have an effect. So as we were talking about bonds, right? So bonds is the benchmark. This is basically where you can park your money and get free interest, right? You're lending money to the government. You're going to get a rate or a yield in return. So let's look at this a little bit further. So let me swap over to a different chart, and I want to let's look at bonds over the last week or so. We can go back as far as necessary, but let's just look over the last week. So today is the 28th. Let's go back as far as, like I said, for the week, but forgive me, I have no idea when the week started. So it's the 23rd. So where are we on here? So here, right in this area right here, right before this consolidation box. And this is the 1 hour interval. Okay. These are Friday's values. It's not really relevant right now, but just take a look at this. Okay. Now, if we go back even as far as, we'll say the 18th of March, in fact, that's fine. Even going back further down here to this low dip, it gets even closer to the beginning of March. Interest rates fell significantly. Okay. And then as we see, we're walking it up. Okay, now this is right when the war started, so as you can imagine, right, and this is all about, and let me go back, and I said this in an earlier lesson, but I'm going to say it again now. This is all about someone trying to make a dollar. Okay, this is the whole point, right? It's where are you going to park your money that's going to give you the best return. Okay, and the first thing you're going to do is compare it to bonds, because this is the benchmark. Can I park my money in the US bond and get a decent return for free virtually, or do I have to go out into the big bad world and invest somewhere else with risk? Right? So the U.S. Treasury is virtually, for all intents and purposes, a risk-free asset. Now compare that to any other asset class or any other stock or business or whatever you want to invest in. There's risk involved in that. That thing could go bankrupt overnight. So that's why we call it the benchmark. So as we can see over this midweek of March, if you will, we can see that bond rates are steadily increasing. And if I switch back to the other chart that I had a second ago, look at, you can see all the way down here. What is this? This is March 2nd. It came down and hit a low that we haven't seen in a while at 3.92. So you could get, it's not much of a return, and that's the whole point, right? You could probably get a better yield out in the other asset classes down here when, at the beginning of March. But now you can look, 20 some odd days later, and it hit a peak of 4.48, almost 4.5. So as you can imagine, and that's the whole point. Don't take this in isolation, but just consider this for a second, that all of a sudden bond rates are starting to come up, right? So where do you think capital, big institutional capital, remember, this isn't our game as retail traders, this is institutional. We're talking millions and billions of dollars here. Where do you think that capital is going to go, right? As the war is going on, now we'll look at one of the other macro oceans, and we're going to look at oil in just a little bit, but for all reasonable supply and demand and everything along those lines, right? Where do you think capital is going to go? As bond is going to give a more, is giving out more yield as it's coming up, where do you think capital is going to rotate to? It's going to come in here and start parking their money for free as these yields are going up, right? That's just reasonable to expect. So if capital is rotating out of the indexes or the stocks and rotating into bonds, naturally those stocks and indexes are going to fall, right? So again, do this as your own exercise, but just take a gander, whatever it is you trade, and walk it through. Look at these days as, starting back on the 18th, for instance, or even go back to the beginning of the month when bond rates fell all the way to 3.9. And watch your specific asset. What happened in your asset as the bond rates climbed? Did yours fall? Did your asset fall? Okay, so that's just, ocean one, bonds, the benchmark. Now let's take a look at gold. Here we go again. Now at the beginning of the year, January, let me pull up gold. Excuse me. Sorry, where did I put it? There we go. Okay. So again, let me do this real quick. So this is the daily. But as you look back even to May, look at, it's been coming up all last year. walking into this year. Gold has been steadily climbing, and then just at the beginning of about just before the fourth quarter last year, it really started to climb aggressively. And then it came up, came up, came up, came up, and then it culminated right here at the beginning of February before it kind of came down, but it's still hanging around in this area. So let's take a look. Let's take a look at it a little bit deeper on the hourly. So again, take whatever asset you trade, and this isn't really so much as what did my asset do per se when you're looking at gold, because gold again is fear. How much do we believe that the economic system is still viable, or are we losing faith in it? And I'm going to race to park my money, again, institutional money, in something tangible, where no one can, delete my bank account or anything like that. As you're printing money, as money is more, the more dollar bills that are floating around, the less value it has, right? So as you can see, as it culminated up there at the beginning of February and started coming down, right? Well, we know that money wasn't coming in here, right? Because if gold was way up here, like we were looking at just a moment ago, if it get back here, if it was way up here at the beginning of March, and now it's way down here now, well, where did it go? It didn't just vanish, right? It probably rotated into bonds, right? So that's where that capital went. So again, if capital's rotating out of this particular asset and rotating over here, what kind of effect do you think it had on your asset? Okay. So now this one, the Euro USD pair. Let's have a gander at this one. Now again, cover this here. Excuse me. This is a little bit more tangible, I guess is the word that I'll use in this case. You'll see this play out far more often. Come on, I'm going to have both of them up there. What did I do with the other one? Nope. So one of these, that's gold. 0. That's that. I seem to have misplaced one of my charts. You are here. It's you. Oh, you're down here. Sorry. You're hidden in my taskbar. Sorry. There we go. Get back up here. All right. So now let's take a look at USD here. That's his Forex. Got it. Wrong one. Having fun now. There we go. All right. So now let's take a look at this one. And let me just double check that this is the right one before Euro USD is at about 1.15. Yeah, we're good. All right. Now compare this one against your asset. Okay. So what we're looking at here is, again, the strength of the currency compared to the US dollar versus the euro. Now, keep in mind that globally, everything's compared to the dollar, right? Dollar is the strongest economy on the planet. So if the dollar is strong, now what you're looking at, you're seeing blue is that the euro is increasing in value, and yellow means that the US dollar is increasing in value. Okay, so when we see that the dollar is increasing, when we see these yellows coming down, it means the dollar is increasing in value, meaning that it's everyone is putting they're rotating their capital into the US dollar, so it's making the euro weaker. And if the euro's weaker, then the people just can't borrow money because it's more expensive. Okay, so conversely, like where you see here, where the euro is getting stronger and stronger, that means that there's more risk on appetite, meaning people are purchasing more, they're manufacturing more, they're taking out loans and so on and so forth. So they're expanding. So that you want to see an ever growing euro dollar, because that means that the world economy is strengthening. You do not want to see countries, rotating their capital into the dollar, because it means that the dollar is strengthening, and then there's fear in the global economy, and money is tightening. So it's that's putting a stranglehold on the economy. So again, compare this to your asset, whatever you trade. Look at it. Whenever the dollar got stronger, what happened to your asset? And whenever the euro got stronger, like in this run right here, the 19th through, sorry, this is the hour chart, but as you look over the last week, as the euro got more and more, as it strengthened more and more, what happened to your asset? Did it climb, or or I should say, did it rally, or did it sell off? Okay. So again, none of this is in isolation. You keep in mind, you've got bond rates that have been climbing. So capital has been rotating out of stocks, indices, right? Rotating out of gold or metals, and rotating back towards bonds. On the other side of it, the euro, when it's been strengthening, capital's rotating out of the U.S. dollar and strengthening the euro. So what? Keep in mind, just keep a watch on what's going on your asset. What actually happened, right? Let's look at the last ocean, and this is oil. And again, we all know what's going on with oil as far as the war and everything along those lines. But what we want to keep an eye on is because oil is a direct correlation to growth and manufacturing. So we want to see this again. This is the hourly over the last week, and we're up at virtually over $100 a barrel now. That's expensive. When you look back at, let me pull this down. Let's look at this for a second. Keep an eye on this. Back at the beginning of the year ish, right? This is late December, early in the year. We're between $50 and $60 a barrel, right? And then bang, the war happened, and there's a stranglehold on oil. For a second, it was $120 a barrel for a second there, or damn near anyway. And now we're topped off yesterday, right around 101. So keeping in, we know what happens when, oil spikes, right? Gas is more expensive, travel's more expensive, and everything starts to get more expensive, right? So when it comes to transportation or anything combustible manufacturing, ships, cargo ships traveling across the seas, right? Bringing inventory from China to all the various countries and everything like that just got far more expensive. So keep an eye on that. Now, all of that said, let's bring this macro chart back down here. This is where I get into the whole, it's a soap opera, and you need to keep an eye on this daily. This is just, again, this is the daily read that I'm looking at right now. But, I'm looking at this at 6 a.m. Central Time prior to the New York Open at 8:30 Central. So that's the whole point. What's going on with bonds? They're still climbing, they're coming down, or, gold is still falling. The euro's up today. The euro's down today. Oil, well, oil's going to be expensive for a little while until this whole Strait of Hormuz, or however you say that, gets resolved. Okay, but now on a daily basis, I have my environment. I know what kind of environment I'm in right now. Okay, so I personally, um, whether I'm trading my own capital in the indexes or I'm trading my prop firm. Um, what do I have here? What do we got here? Nope, 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 nope. It's got to be one of these. Here we go. Here we are. So this is, this is my futures. This is the SPX futures market. I have an idea of what's going on, right? Because I know bonds are going up, so I know capital is going to start rotating out of the indexes. It's pretty straightforward, right? When I look at this and I expand this out, this is my 30-minute. In fact, let's put the 30-minute back and let's just look at the hourly. Okay. What reasonable expectation do I have? You know what I mean? Even if I did this into the 4 hour, let's move this to the 4 hour. If I know that bond rates are climbing, I know that gold, capital is rotating out of gold. I know that the dollar is strengthening. I know that oil is rising. What reasonable expectation can I have that's going to happen in the index? Right. So again, this is what I'm talking about. Compare your own asset to what's been going on against these four macro oceans, as I'm calling them, and then see if it correlates. Okay. And if it's true, then that's my point. Then you should be paying attention to this soap opera of the four oceans of these specific macro asset classes so that you know what kind of environment you're in. And then you know how your climate for your asset class that you trade is going to behave. And then as you get into the final layer of the weather, you know whether today's a risk on or a risk off, and you either are going to be trading into it, you're going to align with it and move with its tide, or you're going to stand down and not trade. And remember that not trading is a position in itself and should always be considered, because capital preservation is the priority when you're trading your asset. So I hope that this was educational. I hope this opened up some eyes. Again, like I was saying, you don't have to trade all of these different asset classes, but you should be aware of them because they do have a ripple effect to the actual asset class that you trade. I hope to see you next time on The Simulated Trader.